Hello everybody. So in today's video I want to talk about HIMS because HIMS is trading at the lowest level of the year at $6.74 a share. And is this stock really only worth $6.74 a share when we are seeing some of the best growth out there out of all of the stocks that I follow? It's really rare to find a stock growing this much, this fast. HIMS is going through unabated growth, even though the story, a lot of people online, noise tells you there's competition, there's a recession, what's going on, the company should not be growing this fast, but it keeps growing. The growth for HIMS is 83% year over year. There is not a single sign of slowdown in the growth and in the adoption of this company. Yet the stock price is not reacting whatsoever to the performance of this company. I cannot begin to understand how cheap this company is. And what prompted me to make this video is, yes, HIMS is incredibly cheap. This is the 10 stocks, the 10 top stocks that I own, my favorite stocks out there. And usually HIMS is just as cheap as Stone, but we're getting to a territory where HIMS is almost 50% cheaper than Stone, actually, than Stone Co. HIMS is trading at a 0.03. Out of the almost a decade that I've used this metric or variants of this metric, I have never seen a stock trade this cheap. We are paying absolutely nothing for the future growth of HIMS when a company is trading at a 0.03 for each percentage point of growth, compared to the way I calculate the valuation of the future growth of other companies like Tesla or Enphase or even a Palantir. Like, some of these stocks are very expensive. HIMS, I cannot understand how cheap this company is. The market is entirely ignoring this stock, dismissing this stock, and to me it's hard to understand because everything about this company is going so well. I have a hard time finding any issues with the company. And let me start this video for a change with some of the concerns, right? Because people are trying to explain why is the stock so cheap. I'll tell you why the stock's so cheap. Because the market makes no sense. Because Mr. Market is manic depressive. That's why the stock's so cheap. But the news, Twitter tries to rationalize why the stock is cheap. And so as I analyze the arguments of the bears, it doesn't make any sense. Like, concern number one is there's a lot of competition. Well, this doesn't make any sense because yes, you have competition for specific products for people that already have prescriptions and that need to get the drugs for prescriptions that they already have, but you have very little competition for people who need both a prescription and a drug, right? HIMS is both an e-doctor and an e-pharmacy, but it's a holistic e-doctor and e-pharmacy. You can get treated for a whole array of different issues, and the competition that comes after HIMS tries to focus either just on hair loss or just on ED or just on heart health. Only HIMS to me has this comprehensive approach. So the concern number one on competition doesn't make any sense as to why this stock is cheap. Now, what about the marketing spend? A lot of people have been criticizing marketing spend. Well, I did a whole 20-minute video addressing the marketing spend. When I calculate marketing spend, in the worst way possible, I don't take customer acquisition costs because I don't have that metric, right? They communicate that metric, but I don't have it. I'm just taking how much money is spent on marketing in one quarter and how many new customers are we getting per quarter. So we're spending an average of $1,100, a little more than $1,100 per subscriber per quarter. But keep in mind, that's the wrong way to calculate it because actually in that amount is included lots of things like marketing research, consumer research, development of new products from a marketing standpoint, advertising campaign. This number is all inclusive. But even when I take this all inclusive number and I look at the numbers, I don't get scared because you're spending $1,100 and you're getting back in gross margin more than $1,000 in 2 years at the best and more than $850 at the worst. That's the worst case scenario. So this gives you a marketing return of 2 to 3 years. You get your money back on marketing spend within 2 to 3 years, which is very good for a company that is this large, growing this large. Like, this is not a company selling t-shirts on Instagram. We can't expect a 6-month return on marketing spend. I am fine with a return on marketing spend between 37% and 43%, which is about the money they make on marketing spend, right? Keep in mind, people who are registered with HIMSS stay for a very long time. If you look at the CEO interview, the latest CEO interview on Fox News, people should stay for at least a decade. That is the general hope of HIMSS. HIMSS treats diseases that you need to have an ongoing treatment, ongoing pills. That's what HIMSS does, right? If you get prescribed for things like heart health, like a statin, you typically take the statin for a very, very long time unless your health improves otherwise. So I find this marketing return to be just fine, about roughly 40% return on marketing spend. That's more than what I hope to earn in the market, right? And in fact, I find any return above 15% to me would be acceptable, keeping in mind that this is not the right way to calculate marketing spend. The right way to calculate marketing spend would look at the granularity of the spending and look at how much spending, for example, is spent on, say, customer satisfaction, is spent on customer service. There's so much that goes into marketing spend. So it's an easy way to look at it like that. But even when you look at it like that, even when you look at it this way, I don't see a problem. I could go on insider selling. People say, oh, there's insider selling, but this makes the headlines. But when you actually look at it seriously and analyze that selling seriously, you realize that insiders are selling almost nothing. Very, very tiny portion of their share. The insider ownership is roughly the same, even if you have an insider that sells about 1% here and there. So it's not a big concern for me. And the last one, concern number 4, people will oftentimes make blanket statements and say, oh, the government is going to ban prescriptions, ban online pharmacy. Governments are going to do that. That's a Burr argument that's always brought, by the way, against any business. Oh, the government's not going to let that happen. How many people do not invest in a stock because they hear, oh, the government's not going to let that happen? Well, that's a general bear argument that you can make about any stock. But even beyond that, when you unpack that argument and you say, oh, the government is going to ban e-pharmacy, what we notice is that HIMSS is largely outside of any potential ban, because whenever you have these articles that are brought up about government banning prescriptions, HIMSS does not sell those substances, those controlled substances that are most often discussed in the headlines. In the headlines, we most often discuss banning controlled substances, which HIMSS does not sell. Another point of contention in the headlines is the GLP-1 drugs. They are not sold by HIMSS. These drugs are weight loss drugs like Mounjaro and Ozempic. A lot of companies have gotten under fire for selling those drugs because there's shortages, and you have people with diabetes who actually need these drugs for diabetes and not for cosmetic reasons, who can't get their hands on the drug. And so this is another idea that has been floated that the government may regulate that. HIMSS does not even sell that. So the two main risks of government bans are not sold by HIMSS. So I am really, really struggling to find the bear thesis. But when I look at the bull thesis, and to me the bull thesis is the sales. How much is the company selling? The sales do not lie when I look at the sale. If you look at the guidance, this is the guidance that they gave us right here for full year 2023. In Q4, i.e. last year, they told us in Q4, we're going to do, let's call it a 745 million in sales, right? In Q1, then they told us, oh, we're upgrading the guidance. We're going to do 820 million in sales. Now in Q2, they're telling us, oh, we're going to do $840 million in sales. This is a company that has raised outlook 3 times in a row. 3 times in a row, they have raised their 2023 revenue outlook. And my guess is they're going to keep raising it in Q4 and in Q3. So if they keep raising the outlook, does that mean we're going to have a full year 2023 with about 900 million revenue? That would be absolutely outstanding. Absolutely outstanding. And keep in mind, this is a stock that is trading at a ridiculous valuation. The product is getting adopted. The app is a top app, top 20, whether you look at Android or iPhone. The product is very popular, yet this stock is trading at a 1.75x sales. Now, granted, that doesn't help us much if we don't know the gross margin, but this is a 1.75 times sales trading at with a margin of 80.25%. The margin is ridiculous. It's a software-like margin for a company that does not sell software. Like this is a really profitable business that is trading at a price to sales valuation that does not make any sense. To me, this stock should not be trading this cheap. Furthermore, this is a stock that has given us long-term guidance. They gave us long-term guidance about 7 months ago. And if you've had the chance to look at the latest CEO interview on Fox Business 2 weeks ago, this interview, you can look it up. The CEO is very seriously discussing how they will likely beat their own long-term guidance that they gave 7 months ago. And they will likely beat it. And this is something that they've hinted a few quarters ago too, that they're going to beat it. It's a minimum, it's a floor, it's a revenue of at least $1.2 billion that they've guided by the end of 2025. That was their guide. But it looks like they're going to do $900 million by Q4 of 2023. And this is a company that year over year is showing growth above 80%. So to me, they're just going to go through that guidance and go way past that guidance. The long-term guidance needs to be updated upward. They need to do that. They haven't done it yet, but clearly this does not apply. And this is why, if you look at the quarterly presentation, the earnings slides for Q2, they do not include that long-term guidance anymore in those slides, because they know full well that they're going to beat that long-term guidance. And we're expecting an update to that long-term guidance. I'm really hoping so. But by the way, even if they didn't, this would be absolutely outstanding at $1.2 billion. So what is the value of this stock? What is the value of this stock? Well, I think they're going to beat that long-term guidance early. So instead of being Q4 2025, I'm going to say that based on their trajectory, they're going to reach that in Q2 of 2025. So that's August 2025 is when we'd find out. So exactly 2 years from now. So if we assume that this very depressed valuation of 1.75 times sales for enterprise value remains the same, and we have a 1.2 billion in revenue, then the upside in 2 years would be 68%, with a stock with an enterprise value of 2.1 billion. That would be the EV if you just use the very depressed. This has been the most depressed ever price to sales for this stock. If you assume in 2 years that depressed valuation will be still there, this is still a 68% upside in terms of an enterprise value, which if you convert that to market cap, remember this is a stock that has cash. This stock has a net cash position, so add back the cash. If you add back the cash, you're closer to an 80% upside, assuming this stock still trades at a depressed valuation. But now, let's be realistic. Let's assume that this stock is going to trade at its historical price to sales, its historical valuation. This is a stock where we've had 12 quarters so far. So I went back into the price to sales ratio of this stock ever since it has been public. And you can see like it started at 3.4, 3.59. You can look, all of these points are the price to sales ratio that the stock was trading at. Divided by 12 quarters, we're getting an average price to sales for this stock of 3.1. This stock historically has traded at a 3.1 times sales. So you do a very simple calculation. $1.2 billion in revenue in Q2 of 2025. That is exactly 2 years from now, August 2025. We assume they reach the long-term guidance that they've given us. We take the historical price to sell of a 3.1. 3.1 times 1.2 gives us a market cap of 3.72. The current market cap is 1.41 billion, which means that, to me, the reasonable upside with the historical valuation, which, let's be frank, for him has always been dirt cheap. Always been dirt cheap, especially if you compare this stock to like SaaS valuation. For example, it has a business model very similar to SaaS, yet the valuation is nowhere near what a SaaS business would command, even though this is a recurring business. This is a business with recurring revenue. Well over 90% of the revenues are recurring. Anyways, the reasonable upside potential based on this 3.1 times sales is 2.64 in 2 years. This is an outstanding return going forward. This is a multi-bagger based on my calculations. So, of course, this is not investment advice, but I bought more HIMS today, and HIMS in the $6 and change range. I cannot believe that I get to buy this company for this cheap, and this is a company that is slowly becoming a bigger position for me, and that may even become a tier 1 position for me. I really believe in this company, but this is not investment advice. This is just entertainment. I hope you were entertained. Please like my videos. I really appreciate it. It really helps. You know the drill. The algorithm loves likes. So if you can give me a like, I appreciate it. And I appreciate all of your subscriptions. Have a wonderful, wonderful day.